The patterns that will be presented are the most common and effective. That means they are constantly seen and frequently impact market movements. Certainly plenty of other patterns exist, but they can be more difficult to use effectively, or they do not appear as frequently as the ones that will be presented. But before that, there will be a few general points to consider. Firstly, chart pattern concepts are relatively easy to understand. However, it takes time to develop and maintain the skills of identifying and utilizing chart patterns to full effect in determining how they can influence future events. In addition, it's important to remember patterns, like any other technical analysis methods, are used to identify more favorable conditions for buying and selling when trading and investing. That means they have a degree of utility in increasing profit potential and decreasing loss potential. Though the degree to which an individual can benefit from chart patterns will depend on their risk tolerance and their ability to analyze, execute, and manage their own unique circumstances. When a chart pattern is referred to as successful, it means a feature or particular set of features formed to produce an expected and or desired result in price movement. When a chart pattern is referred to as failed, it means a feature or particular set of features have not formed to produce an expected and or desired result in price movement. If you have a basic understanding of technical analysis, it means you have a basic understanding of chart patterns. In terms of the basic components of chart patterns, this includes proficiency with swing points, volume, support and resistance, trend lines, and channels. A thorough understanding of general price action will also be essential, along with a firm grasp of candlestick charting for enhanced examination of critical chart pattern phases. If you need to learn those skills or just need to brush up as a refresher, it is highly recommended you do so, especially with lots of detailed chart example case studies. When chart patterns are outlined, we will first begin by highlighting basic chart pattern features, then progressively introduce specific chart patterns that will be presented in the long series of case studies. It will be a relatively brief discussion because there isn't that much to cover in terms of concept and theory. The real lessons come from seeing chart patterns and their component features again and again, under various market conditions. When going through the case studies, not every single chart pattern and detail can be covered. Case studies will focus on certain scenarios and provide general practice with chart pattern analysis in common market situations. Similar to candlestick charting, chart patterns won't always be a perfect match to theoretical diagram criteria, and it can be more realistic to focus on general price action rather than trying to have the exact same criteria being met under the exact same conditions all the time. Overly rigid thinking is unrealistic and can reduce the overall effectiveness of chart pattern analysis. The identification of key swing points, especially in trends and ranges, is a core pillar of effective chart pattern analysis. This includes finer details, such as a line chart with each dot representing closing prices, and the use of normal candlestick charts. This allows for greater clarity in determining reversals and continuations, as well as areas of decreased market activity. Understanding variations and nuances in the development of trading ranges will be critical in assessing whether chart patterns are more likely to succeed or fail. Continuations can be more difficult to analyze than reversals, since the intermediate stage of a resting phase range can often resemble features found with a reversal formation. Extensive knowledge of candlestick charting is highly beneficial in overcoming difficulties when analyzing continuations. These last two charts remind us that continuations and reversals are common features that comprise chart patterns. After all, reversals and continuations are essentially the primary types of price action of interest for any kind of analysis. Continuation patterns can vary, but they share common characteristics to 3 methods falling and 3 methods rising candle formations, except usually on a larger scale. Gaps are perhaps one of the simplest patterns. Regardless of whether it's a gap up or a gap down, market attention gets focused on where the gap opens. Attention is also heavily focused on gap fill areas that become highly influential areas in the development of resistance and support. The empty space that is the price range of a gap can see trading move through it relatively easily, because less market activity or even no market activity is focused at those areas. Gaps often form due to major catalysts and drivers of high volume, such as earnings reports. A high concentration of orders accumulates before the open of the next trading session. Buy orders in the case of a gap up, and sell orders in the case of a gap down. When the next trading session opens, the buildup of orders causes a gap. Since there is a large disparity of buy and sell orders right at the open. The case studies will highlight a variety of situations that can affect price gaps and their effectiveness.